Hello and welcome to a CMS Forex Daily Video Recap. I'm your Fundamental Market Analyst, Nick Nassad. Today is Wednesday, June 30th, 2010. Following two sessions of rather sharp declines in the euro-dollar pair, today we saw the euro rally as it made up about 61.8% of this two-session down move. The reason here was some relief in terms of the funding problems that European banks are facing. The ECB allotted around 132 billion euros in 3-month funds, which it conducted under a fixed-rate full allotment procedure, essentially allowing banks to borrow as much as they wanted at 1% interest. That was a positive sign in terms of the worries about bank funding, as expectations had been for a much higher figure. Demand for the 3-month cash today was a litmus test for the health of Europe's banking system. If demand came in at a higher end of economists' range, around 250 or 300 billion euros, it would have indicated that banks were still finding it hard to fund themselves. The smaller figure of 132 billion euros, therefore, is an encouraging sign that European banks don't need as much liquidity as previously thought. Following our test of this 1.23 level, which I mentioned was a 61.8% retracement and also part of this downward sloping resistance trend line, as well as some of our moving averages, we see that the pair formed a bit of a double top and then declined in late New York trading as we had US stocks turn lower, especially in the last hour of equities trading in the US. Looking at the euro-pound pair, we see an even stronger bounce in favor of the euro as we move from around the 0.8072 level from yesterday's low up to 0.8225, testing our highs from Monday's session. There were some end of the month and end of the quarter flows to consider here, which made for some choppy trading conditions, but we could see the undeniable strength in favor of the euro following the 3-month tender. We also saw rises in the euro against the Swiss franc, Japanese yen, and Canadian dollar as well. While we saw the euro stronger against the dollar and also stronger against the pound, in the pound-dollar pair, we saw the pound sliding against the dollar. We broke this upward sloping level of support around the 1.50 level, and as well as a horizontal level of resistance around 1.50, and we slid down to the 200 period moving average in a 1-hour time frame. Similar to the euro-pound pair, we may have seen some end-of-the-month flows contributing to the decline in the pound-dollar as well as end-of-the-quarter flows, as those traders that have rode the rally in this pair throughout most of June, which we've seen a very strong rise in favor of the pound, may have decided to square some positions and take profit. We also had sterling has risen because of a convincing emergency budget released in the middle of the month, and one member of the central bank's monetary policy committee voted to raise rates at its last meeting, which had stoked some rate increase speculation. However, the pound's rally could be short-lived if the government spending cuts curtail growth and forces the Bank of England to keep interest rates at a record low. If the BOE confirms that, then we could see the pound continue to slide following this topping action to this rally. We also had some data coming in weaker than expected, at least housing prices in the UK for the month of June. The price of a typical UK property rose by a seasonally adjusted 0.1% in the month of June, and by contrast, the annual rate dropped for the second consecutive month from 9.8% to 8.7%. So here on the right, we see the slowdown in price increases over the past 3 months. And here we see the annual pace, which has been rising sharply, also topping off in the last couple of months. In a second report, we saw the GfK consumer confidence for the month of June in the UK fall to a 6-month low as it slid to -19 from -18 in May. Britons are becoming more pessimistic about the economic outlook in the face of the planned government spending cuts that were proposed by the new budget. It was also the 4th month in a row that we have seen the Consumer Confidence Index decline. Turning to a U.S. report, which came at the beginning of the U.S. session and dampened commodity currencies, was the ADP employment change, which measures private sector payrolls, and it came in weaker than expected, reporting 13,000 new private sector jobs created in June compared with an expected 60,000 figure. Disappointing ADP number comes ahead of the official June jobs report on Friday, which is expected to show a decline in payrolls as temporary census jobs are eliminated. From the chart to the right, we can see that the 3 months of positive employment change has been very weak from the ADP index. Taking a look at one of our commodity currency pairs, following a bounce overnight after testing the 0.8460 level and on the rally in Europe, and also a part of a correction to this sharp slide we had seen during yesterday's session, the ADP data gave this pair another negative momentum, and we had a second leg of declines throughout the rest of New York trading and in late New York trading as we had US stocks suffer right before the close. Yesterday we saw the commodity block of currencies slide as there are concerns about weaker global growth following yesterday's weaker data from China, Japan, and the US. Taking a look at Australian data, we had new home sales fall by 6.4% in May from April as higher interest rates bit hard at demand, according to the Housing Industry Association. The Reserve Bank of Australia has raised interest rates 6 times since October. However, private credit demand was rather strong as it rose 0.5% on the month, bigger than expectations, and was up 2.7% on the year, which was also higher than the forecast 2.4%. In a similar dynamic to the Aussie US dollar pair, here we look at the US dollar Canadian dollar and we see a move in favor of the greenback throughout the New York session. Here we retraced around 50% of the rally we had saw in favor of the greenback overnight, and then moved another 170 pips higher to breach the 1.0570 level and go as high as 1.0640 in late New York trading. In addition to the weaker ADP report, there was a weaker than expected Canada monthly GDP figures for April. In that report, real GDP was unchanged in April, which was weaker than the expectations of a 0.2% rise, and was also the first monthly decline after 7 consecutive monthly increases. A larger decline in retail trade and smaller declines in manufacturing and utilities was offset by increases in mining, wholesale trade, and to a lesser extent, the public sector and construction. In another report from the US, we saw business activity in the US expanding in June for a 9th straight month, showing manufacturing is overcoming the turmoil in the financial markets. The Chicago PMI was at 59.1 compared to 59.7 in May, which does mean that growth, the pace of activity did slow, which means that the pace of the increase in activity did slow. The Chicago PMI does measure both manufacturing and service providers. Internally, the employment measure climbed to 54.2 from 49.2 in May, and the production gauge rose to 64.2, the highest level since February from 61 last month. We get the more official ISM manufacturing index in tomorrow's trading session. Taking a look at our final pair, the US dollar Japanese yen, we saw the yen gain strongly in yesterday's session, but then overnight we saw a bit of a counter trend rally as we had this upward channel throughout most of the session, though we dipped at the beginning of the New York trading session following the weak ADP, and then followed that up with a slide in late New York trading as we had US stocks fall rather sharply in the last hour of trading. So that continues the bearish theme we have seen throughout most of this week. And so let's now take a look at the upcoming fundamental docket to see what to expect in tomorrow's trading. First up tonight, Australia posts its manufacturing PMI, which will be followed by the Japanese Tenkan Manufacturing Index as well as manufacturing data from China. At 9:30 p.m., Australia will then post its building approvals and retail sales. Overnight, Germany releases a measure of its retail sales, and we get another manufacturing report, this time from the UK. Tomorrow in the US, we'll start off with our weekly jobless claims, and that'll be followed by the aforementioned ISM Manufacturing Index, as well as pending home sales and construction spending. So that will do it for today's report. For more news, videos, and analysis, please visit our site, cmsfx.com. I want to thank you for watching and wish you good trading.